Hey, this is Cat with Charts for sharkcharts.live, and today I'll be discussing Wave PM. It's going to be a bit longer and heavier than the other videos in this series, since Wave PM is a major intermediate building block in our other indicators. And to understand what it does and why we care, I kind of need to go into the theory behind looking at expansion and contraction of Bollinger Bands. So I'd like to introduce this by quoting directly from page 71 and 72 of the book Bollinger on Bollinger Bands. Perhaps one of the most interesting aspects of Bollinger Bands is the rhythmic contraction and expansion of the bands you can see on the charts. This is especially clear in the bond market, where fairly regular 19-day volatility cycles can be observed. It turns out that there's a fair amount of academic research into this phenomenon, so we'd not be surprised to see a regular pattern in the expansion and contraction of the bands as they reflect volatility about an average, even if such a cycle is not detectable in price. The word regular is the trap. While the volatility cycle of long-term interest rates does seem to have fairly regular 19-day interval, the volatility cycles exhibited for most other financial instruments are nowhere near as regular. However, it is not the regularity or lack thereof that is interesting. The most interesting conclusion is that low volatility begets high volatility, and high volatility begets low volatility. So that brings me to my first chart, where I've plotted on a 5-minute chart 50 and 200 bands, these smaller bands, and then 600 and 2400 bands, which correspond to the 50 and 200 bands for the 1 hour time frame. And what I want you to appreciate looking at this is that on each period there is cyclic nature to the expansion and then contraction, but that isn't a regular cycle. You can't just look at the time between two cycles and line them up and then just trade at the same exact time interval. Now that would be too easy. Instead, it's a patternistic behavior, and it's broadly true of all actively traded markets. It's a little out of scope to go into the theory of why that is. Mark Whistler's Volatility Illuminated has a wonderful discussion of it. Dad Sharks has whole lessons on it, so I'll leave explaining why this happens to a deeper lesson on that itself. What you need to know for the purposes of explaining Wave PM is that this is a phenomenon that happens in markets, and it's tradable, at least if you're relatively small compared to the market and you're not suffering from large slippage because you're the one moving the market yourself. The question then is, well, how would you trade it? So I think even though the timing and the size of these expansions is not consistent, you could reasonably appreciate that you could have an indicator that had a look-back period to look at the change in expansion and contraction of bands, and then at some future point be able to detect that because we're here and the band is expanding this fast, and recent bands typically expanded this fast over here, that we can guesstimate that we are in X part of the cycle. And that is, in a sense, what Wave PM attempts to do. So, in one sentence, Wave PM is an indicator for reading out the relative expansion and contraction state of Bollinger Bands for a given period length and a point in time. It's a key indicator that we use in the strategies at Shark Charts and in the calls. And it's originally published as a MetaTrader 4 script in Mark Whistler's book Volatility Illuminated. scripts derivative directly from Bollinger Bands, and specifically it looks at the recent change in the bands on that period length over a look-back period and normalizes the result so that you get an oscillator from 0 to 1. However, it's not a typical oscillator in that the oscillation method is fairly boutique and normalizes using a piece of a sine function, a piece of a trig function. What's really great about WavePM specifically is that this gives you a readout in reasonable human readable numbers. You could imagine doing this with Bollinger Band width in some form or fashion, but I'm not another indicator on TradingView that does anything close to this, at least in any useful way. And certainly part of what makes this clean is that the normalization makes sense. So it's divided into 4 regions roughly corresponding to a zone where it's been pretty deeply compressed, a neutral zone between 0.4 and 0.7, a sweet spot where it's probable to be expanding between 0.7 and 0.9, and then a spot between 0.9 and 1 where it is expanded so much that we might think of it as overexpanded and liable to start compressing soon. Normally we plot it with 4 different period lengths, 14, 55, 100, and 200. 100 and 200 being added later on to this indicator more because we're looking at instruments that have more volatility on shorter time frames. So there are kind of 2 major signals you're looking for from this indicator. One is the idea that a shorter period expansion is likely to expand into a more compressed longer period expansion, or longer period Bollinger Band, and in doing so will create a high probability to trend because it is likely to then expand that Bollinger Band in the same direction. So we see that with our 200 band here, where it got pretty compressed around here, and slowly got a little bit into the area where it might trend, but not really, and started compressing again. And then on this one, it was the one where we saw the stars align, a very violent short period expansion, started significantly weighting to the downside, way outside the larger band, which at that point had become very compressed. So it expanded violently, overexpanded in fact, and we got a large significant zone of trending. Then, because it was overexpanded and it started taking an unreasonable amount of volume to continue expanding it further, we saw it revert down, start coming down, compressing again for another move here. And this entire first leg of this Ethereum run happened on shorter periods, who had already come around and compressed and started to expand again, than the 200. Now we see the 200 just started coming back up, and as we've been following it and trending above the containment zone on that period, we can see right now that it's telling us that we're probable to continue trending on this. our short period trace is actually fairly compressed, which makes sense since we've been consolidating up here. When it comes up and starts crossing up these periods, we would expect, relative to how these periods are weighted as they start crossing up the longer periods, it to be probable for the trend to continue in that direction until these periods in fact start getting overexpanded, or on a higher time frame we start reaching benchmarks or an opposing overheaded period, or alternatively significant volume comes in to start selling, and though we're weighted up now, enough volume would then cause us to instead move down. But it is probable with the setup that it would move up first because everything is currently weighted to the upside, so it should take more volume to push down than up. So that's one set of signals that we're looking at. The other set of signals is the overexpansion idea, where as it becomes unrealistic for price to continue expanding in distribution, you expect to start having reversion to the mean. You don't necessarily expect it immediately just because it's overexpanded. It's a condition, but not the signal, because you can continue trending and you continue specifically overexpanding longer and longer periods. And especially in a violent trend, the trend is your friend, and it is foolhardy to just be betting against it willy-nilly. But eventually what will happen is that it is no longer possible for the market to come up with the volume to continue trending in that direction. So eventually you cross the 1.25 standard deviation bands. You start behaving much more like a normal distribution about a mean, and you start reverting to that mean wherever it happens to be as it continues to move as a non-static trend line. So Wave PM is valuable both for trading in expansion and for trading reversion. So that brings us to just what different things you can do in our Wave PM indicators settings-wise are. You can change these different period lengths on the light version, which is limited to SMA and normal standard deviation. But you probably don't want to, because these are pretty reasonable benchmark lengths. You could use this in theory to look at much longer periods than these lengths. Normally, because we have more complex indicators offered, we're doing that mostly through indicators like 3D Wave PM and mean reversion MA ourselves. But you could, in theory, use just Wave PM Meowmix Lite to do the same thing with more inconvenience. We have the periods for oscillator lookback variable, which is interesting to demonstrate. Normally, we would not recommend changing this, but it's important to know what your indicators actually do. So if we instead make this in a 1000 period lookback, what you notice is that you get a comparison of current volatility to a much more historical volatility. And what was normal 1,000 4-hour bars back in Ethereum USD in 2018, substantially higher volatility than we saw in October, November. So basically the entire set of traces is trading all as if it's compressed, because relevant to 1,000 4-hour bars back, it all was basically pretty compressed. And on a macro time frame, that is actually important information. The trade-off, and why you wouldn't want to do this in most cases, is that before a move would be considered historically important on your longer period lengths, you will already have had to have missed a substantial amount of it because it will already had to start expanding quite a bit. So the trade-off is that you turn an indicator that can be pretty usefully leading into something that's more of a lagging confirmatory indicator, which is not useless, but not why we're excited about Wave PM. So the full version of Wave PM Mail Mix adds support for calculations of standard deviation based on various moving averages. So if we go to VWA and volume weighting standard deviation, you'll mostly notice that for this particular one, you get spikier results. Certain moving averages will give you very different patterns. Ones that are relatively close to SMA will give you very similar patterns. And the type of standard deviation you use weighting-wise matters less for a Wave PM because it goes through a normalization process anyway than it does for calculating bandwidth and band targets, moving targets. But the features are available on the full version. One additional thing that's added are these unweighted, volume-weighted, and volume-weighted moving standard deviations. And though we don't use these regularly in the strategy taught on stream and by Dad Shark, they're here because I've seen other people interested in this and use it in their strategy. Or instead of looking at the real-time standard deviation as calculated now versus the past required to calculate the moving average of now, they're interested more in the moving standard deviation between price and or price is trading in that moving average such that both variables are moving. And that does produce a somewhat different picture. Notably, it's a smoothing effect where it'll decide that something is more or less significant based on recent past. It saw this as substantially more compressed than the real-time calculation does. It both recognized this area as an extreme expansion. It looks at this and says, because this is relatively similar to the distance it was trading here versus the moving average as far as standard deviation goes, that this is got less significantly compressed than the real-time calculation would suggest. So I would put the moving standard deviation calculations more as experimental options that are in the full versions of our indicators, or rather than ones that we necessarily use in the strategies we show on stream. But in general, with the full versions and the experimental indicators, we've aimed to give more abilities to use these power tools than we necessarily can do ourselves, assuming that they're relatively easy to slot in, which since we wanted to include volume-weighted averages and volume-weighted standard deviations, were a piece that evolved into this tool. So that's going to be the heaviest of the Wave PM videos because it's the one where I could needed to explain what we were even looking at in the first place. The follow-up videos on 3D Wave PM and mean reversion MA will build on this, but I'm not going to go over the whole theory again. But it's important to understand that this is the basic building block for the more complicated indicators, where what you're looking at is expansion and contraction of Bollinger Bands to figure out where in this rhythmic cycle you currently are, and if what expanded bands you might be trending on, and to identify spots where longer periods have become compressed enough where a shorter period expansion can be expected to, in high probability, cause the larger band to start expanding in the same direction.